Good morning, everybody. Let me welcome you all, both here in the room and online, to this new edition of our lecture series organized by the Chair of International Macroeconomics Chair at PSC. And as usual, I have to say, we're of course very grateful to the Banque de France for this partnership where we together try to promote research in macroeconomics with a policy relevant angle. And today I'm perhaps even happier than usual because we have Professor Hélène Rey here with us who will speak to us today. Now, at this point, I would usually say, some brief remarks about her biography. But in this case, I find this a bit difficult, and that's for two reasons. First of all, I'm very biased. Hélène was part of my PhD committee a long time back, and I think it's fair to say that I'm a fan of what she does. So I'm biased, but perhaps more importantly, there's just so much one could say. In fact, in the preparation of this event, Samuel Shish, our communications expert, he sent me a draft version of the website announcing the event, and he commented that the biographical note, which we took from an external source, might be a little long. And I said, oh yeah, that looks a little long. I'd shorten it a little bit. I tried, but I failed because there was just all these things are important achievements. And that's because I understand so many important things. But so I'm not going to do justice to that now. I just want to mention a couple of things. Hélène, you graduated from one of our founding institutions, the EHESS, the École des études en sciences sociales, and from the LSE, never mind. Before you went to Princeton and LSE and eventually joined the London Business School, where you are now Lord Bargary Professor of Economics. You have published in all the top journals of the profession on a wide range of topics ranging from financial crises, global imbalances, the financial cycle that we're going to hear about. I have a list here, monetary policy, capital flows, a wide range of topics. And you received a large number of prestigious prizes, most recently the Prix Turgot, I think, here in France. You're a member of many associations and societies. For example, she's a foreign member of the American Economics Association, not that many, a correspondent of the Académie des Sciences Morales et Politiques, and in 2016 you were appointed to the Order of the British Empire. I have to admit I didn't entirely know what that was, but I looked it up and it's a very prestigious thing. I could obviously go on now, but I'm not going to go on. But I want to say two things that impress me about Hélène first. The first thing is that what you do to promote women in economics. And that's partly by just doing what you do and being a role model, but also more actively. Right now, you're the vice president of the CTR, the Center for Economic Policy Research, in charge of its Women in Economics programs. And I personally think that's very important, in particular in macroeconomics. We have received 160 applications for our junior position in macro. I haven't calculated the ratio of female applicants, but it's too low. And we should change that, and there's a long way to go, but I really appreciate that you're working on that. The second thing that impressed me about Hélène is that she doesn't only contribute to economic science at the highest level, she also contributes to improving economic policy. And in particular, you are one of the three external members of the, and I have to look at my script again, Haut Conseil de Stabilité Financière, so the French macro-prudential authority, a member of the Conseil d'Analyse Économique in the past. And you're a member of the Group of 30, which is this coming together of 30 world leaders in policy, finance, and academia that tries to consult policy making in the world. And recently you co-authored a report on the transition to net zero, which has received a lot of attention, which I think is extremely important, perhaps the most important topic. So I'm tempted to invite you again right now for a lecture about the transition to net zero, but today you're going to talk about something else. You're going to talk about a topic that is kind of your own making in some sense, because if I read the literature correctly, then Hélène was the one that actually discovered this co-movement of financial prices, quantities, capital flows, etc., and the effect of monetary policy on that, which since we have come to call the global financial cycle. So that is what Hélène will talk to us about today. Before I give the floor to you, I also want to welcome our discussant. I'm not so sure that he is able to say anything at this point, but he will be able to discuss the lecture later. And I have to admit a big mistake. I didn't ask him how we pronounce his name, but I will try anyways. Georgiadis from the ECB. He'll be online because he couldn't travel, but we're very grateful that that you agreed to discuss this work. We have never met, but hopefully, I guess I'll at least see your face now. So without much further ado, please, Hélène, you have an hour, and then Georgios has 10 minutes, and then we all do room for questions.
Thank you so much, Tobias. That was far too generous. I knew when you were a student that you were quite promising. I see that I was quite right. So you could come up, and that's great that you're now here. Thank you for all your generous introduction. And today I'm going indeed to talk about the global financial cycle. And this is going to be a lecture which will be based on a number of papers that I've been working on over the years. So of course, I'm going to extract a few things from each of these papers. Some of them are published, some of them are still working papers, and they are written with a number of co-authors. And they all should have credit also for what I'm going to talk with you today. And I just want to point out that with Sylvia Miranda-Agostino, we just worked with the handbook chapter, so a chapter for the handbook of international economics, which have a lot also of references to the literature. So if for PhD students and so on, this is maybe a good source for research. So as Tobias said, I discovered something which looked like a global financial cycle in a paper that I was writing for Jackson Hole, the Jackson Hole Symposium in research of the central banking conference that occurs every year. And when I was asked to think about monetary policy spillovers for that symposium, I realized that there was a number of interesting empirical regularities that were quite important to the international economy. In particular, there was a high degree of co-movement in risky asset prices, in capital flows, in leverage of financial intermediaries, and in various kinds of financial aggregates around the world. So I went on to kind of characterize a little bit more fully that what I call the global financial cycle by estimating a number of global factors, precisely involve financial variables, both on the price side, and we see also now on the capital flow side, and on credit aggregate. And I kind of looked at the correlations of these global factors with a number of measures that here I will present, because I think even though there are correlations, they are useful to try to, when we try to think about theoretical work in international macroeconomics, it's important to have a number of stylized facts in mind. So it is very much in that spirit. And I'm not saying that I will understand all the structural mechanisms behind those correlations, but I think that's precisely a very fruitful ground for a lot of future research. I will nevertheless attempt some kind of structural explanation, at least of part of these movements in the global financial cycle, and I will in particular emphasize the role of central banks. So this is building on some work with Sylvia Miranda-Agostino in particular. So if we take a step back and we ask ourselves what kind of interlinkages we can think about in the global economy, and in particular how we think about monetary policy spillovers and international transmission of monetary policy in the world. Well, there's a number of models that have been used quite heavily in international macro. So one very classic paradigm is the Mendelian paradigm, where we have transmission of international monetary policy, or transmission of monetary policy internationally via the goods market in particular, so via trade. Okay, so we have a lot of work which has focused on changes in relative prices. We have a relative demand effect, we have income effects, and this has been a very important way for us to look at international monetary policy spillover. More recently, I think it's fair to say that there is also a lot more attention which is given to transmission via global value chains. And we have, with the COVID shock, we have one indication of how important that can be as well. But also, and this is where most of my work lies, we have also important transmission channels. Sorry, can you hear me better online? I'm not sure I can hear whatever you say. So
we're working on that.
Does it work better? Okay.
I think so.
Right. So let's hope. Let's hope you can hear me. So this is the international financial side of things, where there is also some pretty powerful transmission channels coming from financial variables, whether we think about risk premia, whether we think about credit creation and so leverage, exchange rates, etc. So this is another type of financial transmission, which seems to be quite important. How does that play out exactly? Well, the thing is, if you look at the world economy through different lenses, it's quite asymmetric. It's quite different what we see. So here, what I'm plotting is a trade network. So this trade network is based on value-added measures. The size of the nodes are proportional to the size of the country in its trading relations. So if you have bilateral imports and exports and imports, which are large, on average, you're going to have a big node. If not, you're going to have a smaller node. And as you can see, if we think about the world in that way, there are some pretty important things that jump at you. You see that the US, China, and Europe as a kind of collection here of gray node. So the gray node are mostly the European countries. If you think of them together, they are going to be like a big third node, essentially, in the world economy. So we have this tripolar world with US, China, and Europe, which are important in the trade network. If you measure trade not by value added but by exports here, same principle. You also see that the countries which tend to be dominating that network are still China, US, and again an agglomeration of Europe. Germany being quite important in that one. So this is one way we can look at the world in terms of interlinkages. But now, if we kind of go to the financial side, which is going to be most of what I've thought about, the world. So the financial side here, the world looks quite different. Here, if you look at it carefully, you will see first of all that China is not there anymore. I mean, it's there, but it's very small. What is left is the US, which is the big node. Then you still have some European countries, which are there. Some interestingly small European countries, small by economic size, but which are important in financial linkages, like Luxembourg, is here. You would have Ireland, if you look, and you also have very small places which become very important, like the Cayman Islands and other such offshore financial centers. So it's a very, very different world if we look at financial linkages compared to if we look at trade linkages. If we look at production linkages, so production networks, because the data is not as rich, we still have there a rather tripolar world. And you see that Germany becomes even more important in the European network. Okay, so there are some differences between the production network and the trade network, but I would say the biggest asymmetry is between the real side of the economy and the finance network, where you really see that we are in a very asymmetric situation vis-à-vis the US. So the US is the big node in the international financial system, and there's a number of consequences or facts which go with that. So in particular, if we look at the role of the US dollar in terms of currency of invoice in international trade, so here we see some data which shows the currency of invoice for imports and exports. if you look at the bars, if they sum up to 2, it means that 100% of imports and exports are invoiced in dollar. And you see that the countries which are the most dollarized from that measure are in Latin America, but also in Asia. So very much outside the US borders, you have the use of dollar as an invoicing currency. And if you move to the right, you have the countries which use fewer dollars in their international trade, and they tend to be European countries because the euro is also an important invoicing currency. Now, another measure of the importance of the dollar in the international financial system is also the share of dollar in foreign exchange reserves. And here, the dollar is the blue, it's blue on the graph, so you see it's definitely the biggest one. You should add a lot of the gray, which is, it says unallocated here for the gray, but it's largely dollar because this is in part the People's Bank of China reserves, for which we don't have the detailed currency breakdown, but there is a lot of dollar. So that means the dollar is clearly dominating there as well. And the euro is the second most important currency there, but you see that the share is a lot smaller. There has been, in fact, a lot of work, both by economic historians, but also more recently on the importance of the dollar in various functions in the international financial system. The importance of the dollar as an anchor currency, that means currency to which countries pay to. And there's a series of papers by Idetsky, Reinhardt, and Rogoff giving you a classification of exchange rate regimes showing how important the dollar has remained after Bretton Woods. There is also a series of papers focusing on the role of the dollar in international trade, invoicing, and financial transactions, with a lot of work in that done in particular by Gita Gopinath and together also with Jeremy Stein. There's a bunch of papers looking at the role of the dollar as a world banker, and this is a lot of my own work with Pierre-Olivier Bourrachard there. And then there has been a long tradition of work on the role of the dollar as a reserve currency by Aishan Green and co-authors. And more recently, we have had some work with Hélène Rey, very much on that with Matteo Maggiore. And we also have some recent work by Ricardo Reis and Bahai. So that's a kind of very active literature on all these dimensions currently. And this goes back, in a way, this kind of literature focusing on various roles of the dollar and how they might interact. This is something that has been pointed out for a long time by economists. And here I've reproduced a table by my former colleague at Princeton, Peter Kennan, which I adapted a little bit. Peter was always emphasizing how interlinked all these various functions of the dollars or the functions of international currencies are in the international economy. The roles of money are all complementing each other and reinforcing each other. So if we look at the medium of exchange versus the store of value role, the unit of account role, and we look at it from the perspective of the private sector and the official sector, it's obvious there are lots of synergies. If you have, if you import a lot in dollar, then that means there's going to be a lot of dollar in your banking system. That also means that your central bank is going to have dollar because we want to stabilize things if things go bad. And it is more likely to happen, all this, when you pay your currency to the dollar, because if you pay your currency to the dollar, prices in dollar are more stable, and therefore you're going to use more of the dollar in international transactions. So this is all very much self-reinforcing, and this is why, in a way, we see this concentration to the dollar in the international monetary system, and the equilibrium is usually considered to be quite stable, even though, I mean, of course, the economic historians very well know there has been before the sterling, which plays the role of the dollar today, and the sterling was replaced by the US dollar. So we switch equilibrium once in a while, and this has massive or important consequences. But once an equilibrium is established, it's quite stable. Okay, so now that we I've set a little bit the stage in terms of what the international financial landscape looks like, I'm going to show you some stylized facts about the global financial cycle and try to go a little bit deeper into that. So what what I did back in 2013 was to take a big panel data of all the risky asset prices I could find. So these are stock prices, these are corporate bonds. And here I will also show some results for capital flows. So you take a big panel, as wide as you can, covering all the geographical areas in which we can have data. And we fit a dynamic factor model to that. So what does it mean? It means that it's a way of trying to understand better the movements of these broad cross-section of time series by fitting a model in which, for a global factor, all the time series we have to load on that global factor. This is how we construct it. For the regional factors, of course, it's only, let's say, the European factor. You will have only the European assets loading on that factor. We can do also by different sectors, but let's focus here on the geographical dimension. And what is of interest is how much variance of the data can be explained by one global factor or two global factor or three global factors, and we can let the data tell us whether there is one or two or three of these factors and how much of the total variance this one or two or three global factors might explain. So this is a way of understanding the extent of co-movements across various time series. If we do that for asset prices, and we do that for capital flow. And so here, so this is a little bit hard to read, maybe, sorry, that table. It's a table that gives you tests for the number of global factors. And the first one is the factor in asset prices, GFC, FAC. And it's essentially the tests tell you that there is one global factor in risky asset prices, and that global factor explains about a quarter of the variance. Okay, so that's about the ballpark. So it's a non-trivial thing. A quarter of the variance of a very broad panel is not a trivial thing. So there is some co-movement there. If we look at the factor in capital flows, interestingly, there the data tells you there are two. So these are the three lines below, but the tests tell you there are actually two global factors, and these two global factors, depending on which measure of the variance you look at, they explain between, let's say, 12%, a bit more, or 34% of the variance. So this is also non-trivial, and we are going to look now at what these factors look like. The first one, the factor in risky asset prices, is presented here. So let's just focus on the dark line, which is an extension of our first paper. As you can see, this factor in risky asset prices kind of does a little bit what you would expect, which is that the shaded area being the NBR recessions, it's dropped quite a lot during those recessions, especially the 2008 crisis. And you can see also, for example, here, that between 2003 and 2007, we had this pretty big general increase in risky asset prices around the world, which is here showing up in the common factor going up quite a lot during that period. Now, what is interesting about this global factor and risky asset prices is that if you look at its correlation with what is generally considered to be market measures of risk aversion, things like the VIX, okay, or the V-stocks, which is the European equivalent of the VIX. So these are financial instruments which are traded and which reflect the expectation of the market on volatility, looking for future volatility. Okay? And so they reflect both the market expectation on volatility and also the risk aversion, because these are priced, so they reflect the stochastic discount factors of the people who price them. And what is quite striking is that there is an important negative correlation between the global factor and those measures of risk aversion, the VIX or the V-stocks, or indeed of remaining measures of risk aversion, or most measures of risk aversion that you can find in the literature on the right-hand side. These are measures of risk aversion constructed by Gert Beckert and co-authors in various papers. And you see that they all kind of negatively co-move quite heavily. So there is a strong negative correlation. When the fear goes up, the VIX goes up, you see that the global factor in risk asset prices goes down and vice versa. What is maybe more surprising, and certainly I didn't quite expect it, is that if you look at the first global factor in capital flow, okay, so it is, you remember that when we estimate this dynamic factor model for the flows panel, we have two global factors. And the first one is represented here together with the global factor in risk asset prices. And they co-move, again, extremely closely. So there is a very strong correlation between the two. So we see that this is one example where quantity and prices are actually co-moving quite strongly here. So it seems that it's a kind of measure of international financial activity, essentially. The volumes and the prices are kind of really strongly tied with one another. And if we look a little bit deeper into this factor in capital flow, so what is interesting is that if we look at capital inflow or capital outflow, essentially it's the same story. So for the global factor, to estimate the factor on total outflows or total inflows, they kind of co-move. So it's really about doing transactions. Okay. I'm going to show you some more decomposition.
I'm going to adjust the microphone once again because we get some feedback that people have trouble hearing. It's fine, but it could be a bit better. So.
Okay, maybe the mask as well, I don't know. Okay, let's try again. So this is another decomposition of this global factor in capital flow, where here we break out those flows into the different subcomponents of the balance of payments. That is, we have portfolio flows, we have FDI flows, and we have also other. Other is mostly banking flows. And you can see that essentially all these subcomponents also co-move quite strongly. There is one which is a little bit smoother than the other, and that's the FDI. It's a little bit smoother, the series, but it also co-moves quite heavily with all the other components. So we have this kind of general measure of financial activity here that is showing up. This is all confirmed if we look at the correlation among these capital flow factors. You see that there is strong correlations between inflows and outflows. We just flipped the outflows here. We gave them a negative sign for clarity. But so you see the correlation is 0.95 between inflows and outflows. Between the factors. If we look at the other flows, there's also very heavy correlation, very strong correlation. The one which is a little bit lower because of the lower volatility is the FDI component. Now, what we can also look is we can look at the loadings of various countries on the global factor. And so here I'm showing you the loadings of various countries in the world on the risk asset price factor. So the price factor I just showed you. And here the loadings are pretty homogeneous for everyone. Everybody seems to be loading on that factor, essentially. So there is a lot of commonality here across countries. So that's the overwhelming message. And therefore, we can already kind of take stock of a few stylized facts here. So first fact, we have this global financial cycle, one global factor in risk asset prices, which is correlated with global risk appetite, explains about a quarter of the variance of the data. Then we have this important correlation between factor in risk asset prices and capital flows. And for the capital flow factor, we have two global factors, which account for about 35% of the variance of capital flows in the spectral density matrix. The first global factor in capital flows is highly correlated with the global factor in asset price. Okay, so these are really these transactions, these are really characteristics of a global financial cycle. The flow components co-move, inflows and inflows co-move, and also across asset classes, there's a lot of co-movements. So this is the first set of stylized facts. Now, what about the second global capital flow factor? Because we had two, remember? And that one is quite different from the first one. Here it is, and you see that this second capital flow factor, it correlates quite strongly with commodity price indices, or oil price. Okay? So that's a very different pattern. It also correlates with a measure of private liquidity quite strongly. So that's now a different characteristics for this capital flow. And so what is going to be interesting is also to see which countries load on which capital flow factor, which is what I'm going to show you next. Yeah. But I'm showing you next. Just to make my points on correlations, the actual numbers for the correlations between the global factor and this set of variables. So again, in the spirit of establishing stylized facts here, I highlighted the highest kind of correlation, mostly between these various factors. The global factor in asset price, as we know, is correlated with the first capital flow factor. So this is the 0.815 up there. It's also negatively correlated with risk aversion, and this is everything in the second panel as we go down the first column. It's negatively correlated with external measures of world financial condition as well. So this is clearly measuring, kind of telling you the same things, on these variables. If we look at the capital flow factor, what is the second one? So the first one is correlated with asset price. The second one is clearly correlated with very different variables. So oil, commodity price, but also output, world trade, world private liquidity, and exchange rate. Okay, so that's a different animal, very different animal. Now here are the loadings. So if here it's a lot more heterogeneous than for the global factor and risk asset prices. And for the first capital flow factor, we see that the highest loadings they tend to be in advanced economies. If we look at Europe, Euro area, but also the UK is in Europe, but not in the Euro area, as you know, and also not in the EU anymore. Just mentioning it in passing. The North America also loads quite heavily, and the Middle East. On the other hand, if we look at the second factor in capital flows, there you have higher loadings toward Asia and a little bit also toward Latin America. Clearly, Asia and Asia Pacific have high loadings. And in Asia, so there is this emerging markets Asia, EME Asia, which is this kind of light gray. This is China. Okay, so this is really China. So that means we see a lot more loading on emerging market, and in particular Asia on this second capital flow factor. We also see some loadings EME Africa. Okay, so that's where also we have some loading for Africa. Now I'm going to look at that a little bit more detailed. If we look at the banking flows, this is the same picture. Essentially, it's the for the first capital flow factor, it's advanced economies and Europe and North America, etc. For the second capital flow factor, it's again Asia and Africa, but it's even more striking for Africa. The FDI component of the capital flows, that's the component on which Africa loads most. Okay, so that's why it loads most. And you see that Asia also loads a lot on this, in particular China. Okay, so that corresponds to potentially quite different motivations for capital flow. So this is another set of stylized facts. We have commodity indices, trade, and the second factor in capital flow, which tend to co-move. We also have co-movements with the global liquidity factor and the second factor in global capital flows. And if we look at who loads on this, on the first capital flow factor, it's North America, Europe, and Middle East. And in the second one, it's mostly emerging markets, in particular China, and Africa loads quite a bit on the FDI component on the second capital flow factor. So now that I established this stylized fact, and I'm not saying I know, I have built the structural models to explain all that is going on here in the data, but I think it's quite interesting to know and to think about, because this tells you what the pattern on international transaction is currently, in particular, how it came to the current situation. I think it's interesting to see how it changes to commodities and energy, and that may be something that moves quite a bit, actually, going forward. And now I'm going to explore a little bit what more structurally, what are some of the drivers of these patterns. And I'm going to first look at the effect of US monetary policy here. So why? I think because the motivation I gave when I showed you the network of international financial network with the US being a huge node here is kind of telling, right? There is definitely a huge role of the US dollar for all these international financial transactions. And so it seems very natural to start the investigation by looking at the effect of the Fed on these international financial transactions. So in order to do that, we build on the literature which has used high frequency instruments to identify monetary policy shocks. So for those of you who are not that familiar, the idea is really that we identify the monetary policy shock by looking at short windows around monetary policy announcement, 30 minutes before, 30 minutes after. And during these short windows, we look at the movement in the Fed funds future. The idea is that 30 minutes before the announcement, the Fed funds future reflects all the information that the market has about the monetary policy and more generally about everything, right? And then during the short window announcement, there's only one thing happening, the announcement. So we can, pretty much say this is a monetary policy shock. And so we see how this affects the Fed funds future, and we use that as an instrument. Here it's for the 1 year rate. And we use that as identification, and we do some VARs in which we are going to focus on all these international financial variables. So that's the idea. And here is what we find here for the US. So this is a tightening. You can see the tightening in the 1 year treasury rate, which is in the third row here. And we look at, so we run a lot of VARs. We check that they give us some, reasonable results in domestic data, we give us domestic data, and then we look at the international financial side. You can see that if we focus on the global financial cycles variable, which are global factor in asset prices, global factor in capital flow, world financial conditions, private liquidity, but also the VIX here, you see very strong reactions. So you see that the tightening of the Fed induces a fall in the global factor in asset price. It's a rise in the VIX. It's a tightening of world financial conditions. It's a fall in global factor capital flows. It's a fall in private liquidity. So all these variables that characterize the global financial cycle are heavily impacted by the Fed. You also see that the Fed has an effect on commodity price indices here and world trade. So it's not only the effect is not only for the financial variables. The US is also an important player in the commodity space and the trade space, but there is a very, very strong effect on the financial side, and there is a dollar appreciation. Now, if we look at capital flows in a little bit more detail, what is also interesting, so they are here disaggregated by inflows to advanced economies and outflows, and same thing for emerging markets. You see that when the Fed tightens, inflows go down and outflows go down to advanced economies. Okay, so this is what we were discussing before, this kind of co-movement. You have a tightening of conditions, somehow the prices are affected, but also the quantities, and everything tends to go down. That's international transactions go down. But if you look at emerging markets, there the effect is asymmetric. for emerging markets, you have inflows going down, but also outflows going up. So for them, in net, this is really a capital slide. It is capital outflows. Okay, so that's very asymmetric response of advanced economy financial markets compared to emerging economies. So advanced economies is just a general decline in financial activity in a way, while emerging markets, it is a net outflow. And we do know that emerging markets tend to have more fragile positions for the current account, essentially. So that's what we can see here. And people may think, there's a lot of there's a long literature looking at outflows and volatility of capital flows to emerging markets, paper tantrum and all that. Now, what I investigated a little bit further also is what happens if you restrict the sample to countries with floating exchange rate regimes. Because there was this presumption in international macro that if you have a floating exchange rate regime, largely you can cushion external shocks by letting your exchange rate take the shock. And that's where you could be insulated from external spillovers. Well, it turns out that I'm not saying that exchange rates do not cushion the shocks. They cushion definitely some shocks and part of the shocks. But it turns out that if you restrict the sample to floaters, you still find strong effects on domestic financial and monetary conditions. So domestic credits going down, credit spreads being affected, leverage of financial intermediaries also going down. So that means when the Fed tightens, the leverage, the credit creation outside the US is also affected, even if your exchange rate is floating. So that's what it means. Yeah. And if we zoom on, the UK and Germany, you see it very clearly. So when the Fed tightens, first of all, there is an immediate effect on the FTSE and the DAX, okay, which is of the same order of magnitude, and which is compatible if you map that into the movement in the global asset price, it's the same magnitude essentially. You see an appreciation of the dollar vis-à-vis the sterling and the euro. But what you also see is an immediate response of a corporate spread, which is again very similar in the UK and in Germany. And you see very interestingly, and this is something people have been working more on recently, you see that there is a policy response of the central banks, of the Bank of England and of the ECB. You see that as there is a tightening of financial conditions coming from the Fed on the global financial cycle, the reaction of the European central banks is actually to loosen in order to try to offset this tightening. And that's quite interesting. And there is a lot more work being done on that currently by a bunch of people, Giovanni Rito in particular and co-authors, but also Shebnem Kalem-Yoskan who worked a lot on that, and also contrasting what may happen in emerging markets versus advanced economies. And emerging markets, the situation is even more kind of interesting in a way, because as we know, some emerging markets have the fear of floating, meaning that if the Fed tightens, they may want to tighten to prevent their exchange rate from depreciating too much. But then that has a big effect on the risk premium, on the spread, and so on. Or some of them actually, and quite a few of them now with an inflation targeting framework, they also loosen their monetary policy, facing a tightening of the Fed. But despite the loosening, they don't manage to offset, in most cases, they don't manage to offset the tightening, the widening of the spread. So the spread still widen, the risk premium still widen. So that means their transmission in a way of monetary policy is quite severely impaired because despite the fact that they try to loosen, the risk premium is still actually goes up. So that's quite a few interesting issues around that. Here is the response, again, just a zoom on on the response of the global factor in asset price and global risk aversion to Fed tightening. So this is the famous risk on, risk off type of idea. If the Fed tightens, it's risk off, global risk aversion goes up. And you see that in very many different measures of risk aversion. You also see the appreciation of the dollar. So that's and the strong effect on the global factor here. These are a bunch of risk aversion measures and how they react to the tightening of the Fed. So you see that they all go up. If you see the stuff going down, it means it's risk appetite, it's not risk aversion, which is the same thing. So there is a strong time variation here, induced, which is a causal effect, we identify, so it's a causal effect of the Fed on risk aversion. And this is something that, in traditional macroeconomic models, or in traditional finance model, indeed, most of the time they don't have any of this. And I happen to believe it's one of the most powerful transmission of monetary policy. So that's a little bit a problem in a way, but a lot of our modeling, a lot of our theories do not generate this type of effect. Here is trying to move forward into the interpretation of what is happening. Here is the reaction of the financial intermediaries to the tightening of the Fed. So it's of course not super surprising that the US broker-dealer leverage should their leverage should go down. They are in the US, okay. But what is important is to see that the US tightening transmits to the EU global banks, which were still very important in the world of banking everywhere. So you see essentially the tightening crosses border, and that's to some extent due again to the importance of the Fed as a central bank for the refinancing of banks in general. The dollar is a very important currency in international banking, in liquidity. Okay, so here, if we again take stock of this bunch of stylized facts, what we have here, and it's a causal effect here, we have identified. Okay, so we have identified the fact that US monetary policy is one of the drivers of credit creation worldwide, so not only in the US. It drives the global factor in asset prices, risk premium, leverage of global banks, cross-border flows. And it's a driver of global risk aversion. And here, if we try to think about what can explain this, what are the channels for which we can have monetary policy driving time-varying risk aversion in global markets, I think, so there are various possibilities and various possible theories and models. What I have been working on mostly is to interpret this through the lenses of models with financial intermediaries, and financial intermediaries which have different degrees of risk-taking, either because of regulation or because of their corporate culture. And when you have very risk-taking intermediaries dominating the market, then global risk aversion is low. When you have more risk-averse intermediaries dominating the market, global risk aversion tend to be higher. And there are composition effects. The relative importance of these different financial intermediaries vary over time with regulation, with monetary expansion. And this could explain, so in my mind, this can explain some of these phenomena with time-varying risk aversion and the role of monetary policy here. So I will show you a little bit more on that. I've been working on this quite a lot. But I'm going to show you that if we look at the share of the different types of assets that were internationally traded between 1990 and now, what is pretty striking is that during the pre-crisis period, during the boom period between 2003 and 2007, you see this huge spike there. And this huge spike is largely due to the role of international banks, the role of banks. Okay, you see this dark blue, the most volatile component, it's banking. So this is a period in which global banks were very large in world markets in terms of pricing assets, etc. And this is also a period in which the regulation on world global banks was pretty lax. So that means a lot of risk-taking to take place, and did take place, as we have found out. This is also a period in which the financing costs of these global banks were quite low. And both because of monetary policy, but also because of regulation, deregulation, I should say, and also because there was a period where there was quite a bit of shortening of financing in repo market, etc. So there was a lot of funding, a lot of balance sheet expansion by global banks, and they were dominating the markets. And given the degree of risk-taking they could do, they were driving valuations up, in my view, and this is one of the drivers of time-varying risk aversion. Now, to give you a little bit more details on this banking story, I reproduce here some graphs that are very familiar for those of you who know the work of Yun-Shin and Tobias. This shows you on the vertical axis the quarterly asset growth of various banks. The first one is globally systematically important banks. Then we have various caps in the banking sector, commercial banks, capital markets banks, etc. And on the horizontal axis, you have quarterly leverage growth. So the point of this graph is to show you that there is a strong movement between leverage growth and asset growth. What does it mean? That means that the banks, and including the very big banks, how do they expand their balance sheet? They expand their balance sheets by taking on more debt. They don't increase their equity. They don't increase their equity cushion. They actually expand massively their balance sheet sometimes just by leveraging up more, which means taking more debt. Okay? So that means a lot of loading on macro risk and a lot of risk taking. That's what it means. They are very pro-cyclical in that way. And of course, when you look at what that implies in terms of so pre-crisis behavior, you see that the average return pre-crisis of global banks or these banks in general was positively correlated with their beta, which means how much they loaded on the macro risk. The more they lever, the more they load on the macro risk. So the more they load on the macro risk, the higher return they get on average. So everybody was expanding massively, taking a lot of risk, valuations were high, returns were high, profits were high. And then, of course, after the crisis, the people who leverage up more, on average, who took on most of the macro risk, they also fell more. And so that's what you see. So this is a very pro-cyclical pattern in the banking sector. I've done some more work, in particular with Nuno Coimbra, looking at that in a lot more detail. And so here, this is just a time series of the leverage quantiles of banks worldwide. So all of BankScope data or CompuStat data, so all banks from various countries. If you plot the time series of leverage, what is quite interesting is that all the quantiles of leverage do not have the same behavior. You clearly have the bigger banks, which are heavily correlated with the most leveraged banks, which are very pro-cyclical. They leverage up a lot between 2003 and 2007. They take on a lot of risk. They concentrate a lot of the assets. Okay? While if you look at the median bank, or lower down, the time series looks very different. So there's a lot of heterogeneity, which in my view reflects heterogeneity in risk-taking across the banking sector. And as you have assets shifting towards the most risk taker, who expand their balance sheet like crazy, which is where you see a boom pattern. So this is what's happening. And then the crisis happened, and then we have low regulation, etc. So there is a massive effect on the banking sector, and that shows up in a decline in risk aversion in the aggregate. So we explore that in a lot more detail in a GME paper with Nuno Coimbra and Dae-Jung Kim, where we do a parametric estimation of risk-taking of banks at the micro level. So we estimate the risk-taking, essentially we estimate value at risk parameters for a cross-section of banks each year. Okay? And we can reconstruct an aggregate measure of risk-taking based on these micro estimates here. And this aggregate measure of risk-taking is the blue line. So if the blue line goes down, it means there is more risk-taking. Essentially, this blue line is a parameter that governs the thickness of the right tail of a distribution in risk-taking. So if there's a lot of very highly risk-taking institutions, the blue line goes down. Okay, that's what it is. And what we do here in a suggestive way is that we put in a few of these regulation events that happened between 1990s and 2008. They are mostly deregulation events, except for Sarbanes-Oxley. And we see that during that entire period, risk-taking goes up. Okay, this blue line is going down. Each time there is a deregulation thing, and there are some important events. There's the Commodity Futures Modernization Act, allowing for more derivative trading here. Is an important one. You have the SEC net capital rule change, important for investment banking, deregulation. It increases risk-taking a lot. Macroprudential policies did not really exist for advanced economies. The red line is kind of useless before 2008. These things did not exist really. And macroprudential policies were introduced after the crisis, plus some re-regulation. You see the risk aversion going back up here, the blue line going back up. So this is only to say this is an interaction of this deregulation plus low financing costs in our model with Nuno that explain this kind of boom pattern, this kind of concentration in assets in the most risk-taking banks, and this situation in aggregate risk aversion. So this is one possible interpretation of the data on the global financial cycle. I'm not saying this is the only one, but this is certainly one that I think is quite plausible. So I'm at the end of the hour, so I'm just going to conclude here to say I think there's a lot more to do. I presented, a few structural interpretations, but a lot more kind of facts here. So there are these fascinating patterns in terms of co-movements in capital flows in risky asset prices, with some capital flow factor also correlated with commodity and trade, which is quite interesting. The US monetary policy key role in affecting the global financial cycle. So the factor in global risky asset price plus the first capital flow factor. Cynthia and Svetinenova have also done a lot of interesting work recently on the ECB and how important is the ECB for the global financial cycle and for the trade cycle, the commodity cycle. And they have these very interesting results that the ECB is not as important as the Fed for the global financial cycle. It's more important for trade and commodity markets. However, there are also some increasing financial spillovers coming from the ECB, especially after the effective lower bound period. So there seems to be more coming out of the ECB there. And with Sylvia and Seti, we also started to work on Chinese monetary policy, because it's clearly an important one to watch for. And what we find here, of course, our identification cannot be as good as for the Fed, because there's not the equivalent of the Fed funds future for China, unfortunately. But we do have an identification, and what we find is that the Chinese monetary policy does not affect the global financial cycle, but is powerful on the global trade and commodity cycle, and transmits to Germany in particular. So that's kind of also an interesting fact. And I think it's important to dig deeper in what is driving those facts. Not, also because if we think about how the world is likely to change, and it is likely to change, both because of China, but because also the role of commodities changing, etc. We need the structural models to interpret what's going to happen or to think about what's going to happen. So I started to work on the boom-bust cycle and the global financial cycle via these heterogeneity financial intermediaries. Okay, but these doesn't address a lot of the issues associated with commodities and so on. So that there's a lot more to do. And finally, this work with Nuno, which marries heterogeneity in restating and financing costs to explain this boom-bust pattern, I think is quite useful to model the restating channel of monetary policy and the interplay between monetary policy and macroprudential policy. So let me stop here.
Thank you very much, Hélène. So as far as I know, now should miraculously appear on the screen or discuss it. Let us wait for a couple of seconds, and if that doesn't work, then...
So I am here definitely, but I can't screen
share. You might
share.
want to share some. Hi, Georgios, by the way.
Hi.
Welcome to us. We hear you from the off. We can't see you, but you want to share some slides, I presume. Is that correct?
Yes, exactly. But apparently I cannot share the slide because I cannot share it while the other participant is sharing. So I guess you must unshare and then I can share mine.
Okay, so I'm going to double as a... I see.
Right.
Okay. Now I presume that online you can still see our screen.
Right. I'm sharing my screen.
Yes. So you. Oh. I've never met you, but I think that was you there for a second.
Yes, me. Let me share the right screen.
Briefly saw you there. I have to say, our Julia and Samuel have been working hard on this. This is the first time that we do a complete hybrid event, so some technical glitches. Take our apologies for that. I shouldn't have talked because we just saw you there.
Yes.
Georgios, you are trying to share your slides, is that correct?
Yes, I'm trying. Can you see them? Yes.
If you put them on full screen on your desktop or laptop, then I think that will be even better, but this is already next to perfect. So please go ahead, you have 10 to 15 minutes.
Can you confirm briefly that you can see the title of the slide, the paper?
So the slide that you see now says the paper in blue and then culmination of a long line of research.
Excellent. Okay, excellent, very good. Okay, so let me start then. So first of all, of course, thank you very much for giving me the opportunity to discuss Hélène's and Sylvia's chapter here. It's a great pleasure and in particular a great honor. It's a great honor because this chapter summarizes a really long line of very influential and highly impactful research that has had big and critical spillovers to many other branches of the literature. And I list a couple of them here, but there are more. Today, I want to focus on an aspect that I think is particularly important for central banks for monetary policy, especially at the current juncture of imminent exit from some of the policies that have been implemented. And I think Hélène didn't have the time or chose to focus on other aspects of the chapter, but in the chapter, there is a section on the effects of unconventional monetary policies on the global financial crisis, on the global financial cycle after the global financial crisis. And within this context, I want to focus on an aspect that I think has been gaining attention recently, namely central bank information shocks. But let me first establish what these central bank information shocks are to make sure that we're all on the same page. Now, this chart here is taken from one of Sylvia's papers. And what you can see here are the effects of US monetary policy shocks on US variables. You see 3 lines in each of these panels. 2 of them, the dashed lines, are, let's say, traditionally identified monetary policy shocks. And as you can see, they give rise to counterintuitive effects on US variables. A contraction in US monetary policy shock gives rise to an expansion in output. That's clearly counterintuitive. And once Sylvia and Giovanni here in this paper, they cleanse cleanse from central bank information shocks, the sign of the real activity response flips and the impulse responses become intuitive. So the point here is that once you cleanse from central bank information effects, the effects of monetary policy are estimated to be intuitive. And the idea behind this central bank information effects is that when you observe an unexpected monetary policy tightening, this does not necessarily reflect the deviation of the central bank from its policy rule, but it could reflect that the central bank is systematically responding to the evolution of the economy, but just that it has some private information that the market doesn't have. And by affecting this tightening, it conveys this information to the market. Now, as I said in the chapter, Hélène and Sylvia also look at the effects of unconventional monetary policy measures, and they cleanse from central bank information effects. They do this for two dimensions of monetary policy, for a pure or for a short end yield curve monetary policy dimension, which you can think of as a forward guidance or a QE signaling effect. And what they find is that it's important to account for these central bank information effects. You see here in the panels that an expansionary short end yield curve shock that lowers the 10-year rate is associated with an increase in the VIX if you don't account for central bank information effects. And only once you account for them do you get this intuitive decline in the VIX. Now, I don't have to say how important this VIX and the risk on-off channel is, given how much Hélène has talked about this. So it's clearly important to account for these central bank information effects. However, at the long end of the yield curve, you can think of this remainder QE effects. Apparently it doesn't work so well to cleanse from these central bank information effects. An expansionary long end yield curve shock that lowers the 10-year rate is not associated with a clear increase in the VIX, but still the VIX counterintuitively doesn't really fall. If anything, it rises at medium-term horizons. So in my discussion today, I want to focus on these central bank information effects. The first point I want to raise is a technical point, if you want. It's a nerdy point, and it's about how to cleanse from these central bank information effects. Although it's a technical and a nerdy point, I think it may still be adequate to talk about today, because I think once you cleanse from these information effects in a way which I think is more consistent, then as I will show you, one can establish that really all dimensions of US monetary policy affect the global financial cycle in intuitive ways. The second point I want to put up is a question whether we shouldn't regard central bank information shocks just as a nuisance and say, okay, let's account for them, let's control for them, let's cleanse from them, and then let's go back to monetary policy shocks. I want to ask the question whether we should be looking at central bank information shocks in their own right. And this is because obviously they are related to monetary policy. And second, evidence suggests that they also transmit through risk on and off effects. So again, this is a recurring theme, this risk on and off, that seems to be also relevant for central bank information effects. And as I will show you, I think that once we do this, we reinforce our understanding of the role of especially US monetary policy as an important driver of the global financial cycle. So in the paper, Hélène and Sylvia, they adopt this poor man approach of Jaroczynski and Karady to cleanse from central bank information effects that builds on the co-movement between equity prices and yields around these intra-daily windows around the FOMC announcements. Jaroczynski and Karady, they apply this in a context where they don't look at multiple dimensions of monetary policy. They just look at an overall monetary policy stance. And I think in that context, it works well. However, I don't think it really works in a multi-dimensional monetary policy context. I put together here a short example. I'm not going to go through this in the interest of time, but I think intuitively, the issue is that you have 4 potential shocks, information shocks at the long end and at the short end of the yield curve, and monetary policy shocks at the long end and the short end, but you work just with 3 surprises in Swanson's path factor, its QE factor, and equity prices. And so it's not clear how to back out the 4 shocks from these 3 observations. There are, I think, fairly intuitive ways to overcome this using sign restrictions, but I think an even more elegant approach, and more importantly, I think less restrictive approach, is to follow what my colleague Marek Jaroczynski has put up in a recent paper. And he starts from the observation that these intraday surprises in yields and equity prices around FOMC meetings, they're highly non-Gaussian, leptocortic. And you see this here in these 2 charts that I took from his paper. These show you the distribution across these FOMC meetings of the surprises in short-term treasury yields and equity prices. The blue bars are the data, and then you have a fit of a normal distribution and t-distribution. And as you can see, the normal distribution fits very badly. The t-distribution, which is very leptocortic, fits much, much better. And so against this background, Marek then postulates an identifying assumption that there's a number of unobserved shocks U, and these map into the observed surprises Y, the treasury yield surprises and the equity price surprises. And importantly, that these unobserved shocks are student t-distributed, which then produces leptocortic surprises, as you see in those top panels. He then estimates this model, and importantly, he backs out these unobserved shocks U. And at this stage, these shocks are just statistical objects. They don't have any economic interpretation. What I find elegant is that he then labels these shocks ex post based on the patterns that they elicit in financial market variables. Here's a chart from a follow-up paper that we're writing together with Marek. You see here 4 columns. In each column, you see the effect of each of those 4 shocks on a range of financial market variables. And what you see in the first column is that the first shock Marek backs out. It raises the treasury yield curve. It does so especially at short horizons. That's the blue bars. The first shock raises this treasury yield curve primarily through an increase in the risk-free component, the expectations component. These are the green bars. This first shock, it doesn't really affect term premia, or it doesn't really affect the yield curve through term premia, and it leads to an increase, a drop in equity prices. That's the cyan bar at the bottom. So this shock looks pretty much like what a conventional monetary policy shock would do. In the second column, you see that the second shock, it also raises the treasury yield curve, primarily at medium-term horizons. Again, it raises it through the expectations component, the risk-free component. Has very little impact on term premia and also contracts equity prices. So it looks pretty much like a forward guidance shock. Third column shows you the third shock. It raises the treasury yield curve only at long horizons, primarily, or in this case, actually exclusively through term premia. And so this looks pretty much like a QE and LSAP shock. And the last column shows you the effects of the fourth shock, which also raises the treasury yield curve. Exclusively through the expectations component, and that one leads to an increase in equity prices. So that looks pretty much like a central bank information shock, and he calls it a Delphic forward guidance shock. Now, in this follow-up paper, then we document that these shocks, especially the Odyssean forward guidance, which in Hélène and Sylvia's parlance is the short end yield curve shock, and the LSAP shock, which again in Hélène's and Sylvia's parlance is the long end yield curve shock, they have intuitive effects on US financial markets, especially the VIX, which is the starting point of my discussion. But what I show you here in the red rectangle is a comparison of the effects that we estimate based on Marek shocks for the impact on the VXO and the effects that we get in our estimation framework if we apply this poor man cleansing. Sorry?
Yo, sorry. We got disconnected here in the lecture theater. I have you on my phone still, but that's not particularly good for the rest of the audience. So bear with us for two minutes, and then you may have to jump one slide back. We're trying to solve this issue. You got disconnected in the middle of that slide, and we're trying to reconnect. I personally have no idea how to operate this, so we need to find somebody. Bear with us for apologies for this.
Yeah.
I don't know what triggered the disconnection.
I don't know either. I have full trust in our technicians that usually that works perfectly, but I guess today's things are a little bit difficult.
How to figure out.
Where did I get disconnected? At which point?
You got disconnected on the slide that you're currently showing that I can see on my phone, but nobody else in this lecture theater can see.
But at which where should I start again? Which column did I manage to?
You had finished with the conventional column.
Okay.
So,
okay.
Then if you start with the Odyssean forward guidance.
Okay.
But we're still looking for a technician. So and my apologies. We still need to you still need to bear with us for a second.
No problem.
So you emphasize in the beginning
we'll move to intermediary questions until we get the slides back up, and then you continue.
Okay.
I was wondering, like, how this is then relate. I was thinking about like shocks for the global financial cycle, but then feed in back again real on.
Okay, so we're told that there's no internet on the whole campus, unfortunately.
Okay.
At this point, you know what I'm going to do? We're going to try this. I'm going to have you on my phone, and maybe you can continue your discussion without. Have you sent the slides around?
Yeah, I shared the slide responding to Hélène's email. So, but I can send them to you again if you want now.
Well, we can put them on we will put them on the website because at this point I won't be able to access them at all, I don't think.
I sent them the other day, responding to Hélène's email, so it should already be in your inbox.
But so let me try. You can, okay, you can say something. Georgios,
can you hear me? Yeah, everybody, or just you?
Okay, so we will not be able to see your slides, but the audience will be able to hear you like this. This is very pedestrian. I'm sorry, but so if there's anything you can share, we will share the slides online. Unfortunately, there's no internet on campus, so I don't think we can even retrieve the slides at this point.
Yeah. Okay. So you want me just to go on?
In the audience, there was an idea whether this might be actually wow. Okay, so we have your slides. Then we're almost ready to roll. If somebody can put this on, how do I put this? F11. Control L. Okay. Okay, so you just tell me when you want to move your slides and you talk.
Okay, excellent. Very good. Okay, so on slide 9, I was showing you the daily effects of these shocks that Marek backs out. And I was talking about the first column that based on which he labels this first shock as a conventional monetary policy shock. And then when you look at the effects of this second shock in the second column, which raises the yield curve, especially at medium-term horizons, raises it through the expectations component, the risk-free component of the yield curve, barely affects term premia and lowers equity prices, then this looks pretty much like a forward guidance shock. In the third column, you see that this third shock raises the yield curve at long horizons, does so exclusively through term premia, which looks pretty much like a QE shock. In the last column, you see that this fourth shock raises the yield curve through the expectations component exclusively and gives rise to an increase in equity prices. So this looks pretty much like a central bank information shock, and he calls it a Delphic forward guidance shock. If we move to slide 11, not 10, but 11.
Is this the one with the, okay, I have the same as on that you're showing.
Yes. Okay. So there you see that in this follow-up paper with Marek together, we also document that his shocks have intuitive effects on U.S. financial variables. We show this here for what Hélène and Sylvia call the short end yield curve shock and the long end yield curve shock. And we show this here for the S&P 500 for the VXO. Again, the VXO is a key variables in the risk-taking channel of monetary policy. And what you see, the red rectangle in the lower left-hand side panel, is that when we use the path shock of Swanson, which is I think what Sylvia and Hélène use, and we cleanse them using the Poorman approach, then we also get, let's say, less intuitive results, which is the starting point of my discussion. So if we move to slide 12, the point I want to make here is not that there's something fundamentally wrong with the claims made in the paper about the effects of unconventional monetary policies. It's quite the opposite. I want to argue that if we adopt an approach that is more consistently cleansing from central bank information effects, there is a chance we can establish that consistently for all dimensions of US monetary policy, it affects the global financial cycle in intuitive ways. Okay, so let's move on to slide 14. The second point I want to raise relates to the question whether we should look at central bank information effects in their own right. And the reason for this is that it has been documented that pretty much like monetary policy shocks, these central bank information shocks unfold through risk on off effects. And again, critical transmission channel for the global financial cycle. I put here some quotes from another of Marek's papers where he looks at the transatlantic spillovers between the US and the Euro area for monetary policy shocks, pure monetary policy shocks, and central bank information effects. And each of those quotes, I think, highlights pretty nicely that risk on-off investor sentiment, animal spirits are key transmission channels for the central bank information effects. On slide 15, I again show you estimates from our joint follow-up paper, which confirm that these US central bank information effects, these Delphic forward guidance shocks, they are expansionary for the rest of the world in terms of real activity. Industrial production goes up. They also have this risk on effect in risk aversion. They lead to a decline in the MB spread and an increase in global risky asset prices, which suggests that we need to think more carefully about the effects of US monetary policy once we take into account central bank information effects. Because here a monetary policy tightening through a central bank information effect has the opposite qualitative effects on risky asset prices in the rest of the world as compared to pure monetary policy shock. At the same time, what you can see in the last two panels is that even a positive central bank information effect, even if the Fed has a better assessment of the state of the economy, still leads to contraction in global capital flows, especially global cross-border bank credit. And that's intuitive and consistent with a lot of existing literature, because if you look at the last panel, it shows you that the dollar appreciates. On the next slide, 16, where we distinguish between advanced and emerging market economies, you see two things, namely one, cross-border bank credit drops in particular for advanced economies, not so much for emerging economies. And in the last panel, you see that the exchange rate actually appreciates, the dollar appreciates actually only against advanced economies, and that's consistent with a UIP interest rate differential story, whereas for emerging market economies, the dollar depreciates, and that's consistent with the risk on in case of a central bank information effect. And Hélène already mentioned the work of Kalemli Özcan that is exactly about this. So on the next slide, I think I'm going to skip this in the interest of time. What I wanted to point out in this second, in the second part of the discussion was that
yeah, keep going, Jago. Yeah. Perfect.
So in the second part, I wanted to point out that we're used to think of U.S. monetary policy shocks as a gauge to infer how systematic U.S. monetary policy plays out, unfolds. And clearly, I think we're more interested in the effects of systematic monetary policy. However, I think that's not so clear anymore once we have two monetary policy shocks, a central bank information and a pure monetary policy shock. Luckily, at least for global capital flows, both seem to have very similar effects, at least for advanced economies. And the final thing I want to point out is a question, namely whether we can learn more through counterfactuals, especially about the role of risk on-off as a transmission channel. And I put up here on slide 19, a little exercise, results from a little exercise in which I looked at a contractionary pure US monetary policy shock that raises the VXO and also leads to a contraction in Helene's global factor of risky asset prices. But once we shut down the VXO, or intuitively, once we shut down the risk-taking channel, then also the global factor of risky asset prices drops much less. So again, I think that underscores the role of the risk-taking channel for US monetary policy. And maybe these sorts of counterfactuals are quite informative about the importance of different channels. And so I'll stop here, and I hope this was marginally helpful, and I'm looking forward to the general discussion. Thank you very much.
Oh, sorry, just one question for understanding, which I think is important. So the red line, how do you generate that?
Yeah, so I skipped one slide. I think this was slide 17, where we have a paper in which we explore the role of the dollar exchange rate, dollar appreciation in terms of the transmission of global risk to global financial conditions. And there we explore a particular approach to construct counterfactuals. This is a minimum relative entropy counterfactual, which seeks to determine, let's say, a counterfactual world, roughly speaking, which is as similar as possible to the actual world, with the only difference that the VXO doesn't go up in response to a contractionary US monetary policy shock. Yeah.
Okay.